Crompton is in focus. Kaleeswaran Arunachalam, the CFO of the company, is talking to us. Crompton Consumer Electricals is the company coming out with the results. And Kaleeswaran, let's talk about air conditioning space to start with. While a lot of air conditioning companies have highlighted strong demand outlook for the segment going forward, how has the demand been for air coolers, and exactly what is the expectation for rest of the year earnings as well?
Let me start with Q4 and give you a glimpse of how the year has been. Specifically, you would ask for two categories. I'll start with that. But we build this total portfolio as ECD. Our overall ECD category has grown very strongly for the quarter at about, say, 14% growth. And within that, fans has grown once again in double-digit revenue growth. And probably after many years and quarters, as a company, we have hit a double-digit revenue growth as Crompton overall portfolio. Now, fans, it's important to note that we have crossed the milestone for the first time by selling 2 crore plus units of fan across. And that's a significant milestone for us. And the demand has been very strong. Our volume growth for Q4 has been upwards of 15%. In fact, in air coolers, we have recorded our highest ever sale in Q4, where we have almost close to 200,000 units have been sold in Q4 on air coolers. As we look at Q1, the trend seems to be very positive. The summer has been strong. We need to see how does the last few weeks of summer pans out. But so far, it has been good. The El Nino effect has been hitting the country very hard, to be fair. And the number of days where the warm temperature or the warmest temperature we've seen is probably at a historic high. So that has led to very strong demand for fans and air coolers. And as we look at the later part of the year, considering there is a lull, also in place, we expect some of our other categories in the portfolio, like geysers and pumps, also to be benefited by that.
Morning, and what about the lighting EBIT margin that has remained under pressure? Is the worst over? Can we expect an improvement now?
See, the good news is we have already hit a double-digit EBIT margin. Last year, we ended at an EBIT margin of 9.5% in lighting. We have already moved to about, say, close to 11% in FY24. Specific to Q4, we delivered an EBIT margin of about 9%, but this also includes an EPR impact, the extended producer responsibility liability that had to be covered in Q4 on a full year basis has hit us with about 6 crores of cost. So if I adjust for that, the EBIT margin of lighting continues to improve. On an exit basis, we're already at 11% EBIT margin. But more than the EBIT margin, the financial model is very strong for lighting. The B2B portfolio is already delivering strong growth. Now we would like B2C also to follow the same trend. And with operating leverage kicking in, that should also play out in terms of margin expansion for lighting, rather than looking at any other initiative at this point of time. Good amount of progress has been made on the cost actions that we need to do on lighting. That has helped us to have a very strong financial model, irrespective of the revenue challenges that we had. Now with one segment back on track and the other segment moving in the right direction for lighting, the focus is to deliver stronger revenue growth.
Right. Your margins have seen a contraction even in this quarter and have remained around that 10% mark. Is this the range that will continue going forward as well? Or is there expectation that you can beat that mark?
See, I would like to take you back to the Crompton 2.0 strategy. It's important to note that we have a brand that has the ability to straddle across segments and price points. We have a brand that has got a national presence and a market leader in many of the categories that we are operating in. Plus, our go-to-market is a big strength for us. On this background, when we launched Crompton 2.0, the priority was how do we accelerate our revenue growth by having meaningful consumer-led innovation? How do we further strengthen our go-to-market and have a strong supply chain to deliver those products? Some of these initiatives have started giving us early wins already, which is where you're seeing the revenue growth. What used to be an 8% revenue growth last year or a 3% revenue growth has now moved to 12% in Q4, and a full year revenue growth of double digit has been already coming. Now, so in far as margins are concerned, when we started Crompton 2.0, our priority was to deliver a revenue growth and deliver absolute profit growth. Now, when we do this, if my profit growth is going to be better than the revenue growth, that will expand the EPS and create value for all the stakeholders. So if you look at the exit margin, we have already hit about 11.5% EBIT for Q4 as compared to starting the year at about 9.1%. So there has been margin expansion that has also started to play out. As we look at the future, we want to see this carefully. It is important that we nurture the business for long run. If you see our financials on a whole, you would see that almost 3.5% has been invested behind the brand and more than 1% is invested behind innovation. This used to be more than 110 bips compared to the previous years. So this is also an important element where we want to invest some of our profits back into business for long run. But in a nutshell, aided by strong competitive performance on revenue, coupled with operating leverage kicking in, we should also see margin expanding in the long run.
Thanks very much, Kaleeswaran, to join us and discuss your numbers.
If you like this video, then like, share and subscribe to ET Now.